Let's get right to it. Welcome to this Strategic Explainer. Today we're conducting a deep dive into an issue that's likely top of mind for many of you. We're looking at how rapid digital transformation, paired with the sudden explosive emergence of generative AI, has fundamentally altered the risk landscape for small business lending. If you're a banking leader, a risk executive, or a lending professional, you already know that the traditional paradigms of credit underwriting just aren't sufficient anymore. We are facing a sophisticated, highly automated fraud ecosystem out there. And surviving it? Well, that requires an entirely new architectural approach.
Here is our roadmap for today's briefing. We'll start by examining the threat landscape. Then we'll compare consumer versus SMB risk, break down the anatomy of SMB fraud, and look at modern data architecture. Finally, we'll cover next-gen AI models and wrap up with building a multi-layered defense.
Section 1. The threat landscape. The weaponization of AI in financial ecosystems.
So let's dive into the reality of what we're facing. The rapid push toward embedded finance has inadvertently opened the door to incredibly sophisticated, automated fraud schemes. The bottom line up front here is that traditional rules-based engines and static verification checks are structurally incapable of stopping adversarial AI attacks. Fraudsters are now leveraging generative AI to rapidly mass-produce manipulated financial documents, use deepfakes to bypass verifications, and spin up entirely synthetic identities in seconds. Because this threat is automated and scales infinitely, relying on a static defense is effectively planning to fail.
Moving to Section 2. Consumer versus SMB risk. Why commercial lending requires a distinct risk taxonomy. We really need to understand why commercial lending can't just borrow consumer fraud models. There is a stark contrast between these two environments. In consumer lending, behavior is relatively predictable. You usually have robust credit files and a single identity to focus on. But in SMB lending, it's a whole different ballgame. We're often dealing with thin-file businesses, highly informal ownership structures with multiple linked entities, and cash flows that change rapidly. And crucially, the dollar exposure is significantly higher. Small business fraud is uniquely dangerous precisely because it combines the behavioral complexities of consumer fraud with the heavy financial impact of commercial attacks.
That brings us to Section 3, the anatomy of SMB fraud, deconstructing modern attack vectors.
Before engineering any predictive models, we have to explicitly define what we're trying to catch. The first major threat is synthetic business fraud. This is where malicious actors create fictitious or partially synthetic businesses. They do this by stitching together legitimate data, like a recycled address, with fabricated online presences and manipulated registration records to bypass traditional KYC checks. And remember, because commercial lending involves vastly larger dollar amounts than retail credit, often hundreds of thousands of dollars per incident, a single successful synthetic business can inflict massive financial damage.
Next up, we have bust-out fraud. This is essentially the long con, and it's particularly insidious. Fraudsters will intentionally establish what looks like a perfectly legitimate payment history over a period of time. They mimic your ideal customer. Then abruptly, they draw down massive credit balances and just vanish. This specific tactic completely blindsides static historical analysis because right up until the moment they bust out, the account looks mathematically identical to a highly profitable low-risk borrower.
Beyond those, organizations have to defend against a whole spectrum of other vectors. Identity fraud now regularly features deepfake-assisted bypasses. First-party fraud involves actual applicants intentionally inflating their revenue or fabricating invoices, fully intending to default. You've got application fraud run by coordinated rings, and account takeovers that compromise your mature, existing borrower profiles. Fraudsters know lenders are pushing for faster, automated underwriting, and they are actively exploiting that speed to slip these diverse typologies right past legacy defenses.
Let's shift gears toward the solution space in Section 4, modern data architecture, shifting from static attributes to behavioral signals.
Your predictive models are ultimately only as strong as the data you feed them. And one of the core mathematical challenges we face in fraud detection is extreme class imbalance. As you can see, fraudulent applications represent a tiny, tiny minority compared to the vast ocean of legitimate applications. Because of this, standard accuracy metrics are actually incredibly misleading. Think about it. If you simply build a model that predicts every single application is legitimate, your model might be 99% accurate, but it has absolutely zero value for catching fraud. That's why, clinically speaking, metrics like precision, recall, and PRAUC, that's precision recall area under the curve, matter so much more than basic accuracy.
So how does this translate into actionable feature engineering? Let's walk through this matrix. Identity stability looks at time-based factors, like the age of a business registration. Velocity flags urgency, things like IP reuse or multiple applications hitting within 24 hours. Consistency checks the logic, such as whether the stated revenue actually aligns with known industry ratios. And finally, behavioral features. These are absolutely critical. By analyzing things like keystroke dynamics or how a user navigates a session, sophisticated feature engineering transforms raw device data into powerful signals that automated scripts find extremely difficult to fake.
This data feeds directly into our next step, Section 5, Next-Gen AI Models, Machine Intelligence, and Network Analytics.
We are long past the point where a single algorithm can save the day. To optimize capture rates while keeping false positives low, a layered framework is an operational necessity. Use supervised machine learning like XGBoost to catch known historical patterns. At the same time, unsupervised models like isolation forests are running in the background hunting for novel anomalies, the stuff you haven't seen before. Layer in behavioral biometrics to screen device interactions and top it off with agentic AI to automate the heavy lifting of evidence collection and investigation workflows. This dramatically reduces analyst fatigue.
Within this advanced framework, graph analytics is a massive competitive differentiator. You see, fraud rarely happens in isolation. Synthetic entities and coordinated rings almost always share underlying infrastructure. Graph analytics uncovers these hidden structures by mapping the entire ecosystem. It connects the dots between shared IP addresses, overlapping EINs, and interconnected bank accounts. A single application might look perfectly clean on its own, but its structural linkages to known fraudulent clusters, those are practically impossible to hide.
This brings us to our final section, multi-layered defense, the target state architecture for modern lending.
Let's pull this whole strategic briefing together and map out what a fraud-resilient lending ecosystem actually looks like in practice. It flows through 4 interconnected steps. Step 1 handles the foundation, your basic KYC checks and regulatory hard stop rules. Step 2 applies that machine learning behavioral scoring we just talked about. Step 3 widens the lens, using graph analytics and network intelligence to catch coordinated rings. And finally, Step 4, real-time API streaming and decisioning. This last step is non-negotiable, folks. Once funds are dispersed, fraud prevention becomes drastically harder, if not impossible. Real-time, continuous risk scoring is absolutely essential.
Ultimately, this is the core thesis of a mature risk ecosystem. The goal here is not simply automation for the sake of automation. The goal is intelligent orchestration between machine intelligence and human expertise. Effective fraud programs require really deep cross-functional collaboration. Plus, balancing that raw predictive power with explainable AI techniques is both a regulatory mandate and an operational necessity to ensure your decisioning is transparent and fair.
I'll leave you with this final thought to reflect on today. As synthetic fraud and generative AI attacks become fully automated, and as they scale at speeds we've never seen before, is your lending ecosystem actually adapting in real time? Or is your architecture merely reacting to yesterday's threats? Thank you for joining me for this explainer. The time to modernize your risk architecture isn't tomorrow, it's right now.